Hey everyone, welcome to the KE Report. Another new year daily editorials. We are chatting with Joel Elconin, co-host of the PreMarket Prep Show, which we will link to in the show notes. Joel, let's give a quick little recap of the last couple weeks. We didn't have a chance to connect with you over the last 2 weeks that were very much holiday shortened, more just separated weeks with Christmas on Wednesday and New Year's on the following Wednesday. We didn't get that Santa Claus rally, but in all fairness, the markets did so well throughout the year that look, we were due for maybe a little bit of a cool down, but now it has everyone wondering how important is the start of the year as we are seeing a bit more positive price action. So, Joel, how important is the start of this year after, again, no Santa Claus rally and just how well the markets did all of 2024?
Well, thanks. First of all, good afternoon, and thanks for having me. I always enjoy being around with you guys. What you got to realize is that, Santa Claus was okay the first couple days, right? And then, the next, the first couple days before the holiday, and then the first three trading days of January. So we've only had two trading days of January, and Monday we could be right back up. But I think you make a couple good points here. The holiday midweek, I mean, I think it just threw everybody off. I mean, when I was doing my broadcasts, I would say, on Thursday, I was saying back over the weekend, when it was really only one day off. And I think people, cleared the books out, kind of going into the end of the year. There wasn't a big anticipation for year end selling, but people decided, to ring the register. And then now it just seems like, the new money's coming back to work. I think that yesterday, the price action in Apple and Tesla kind of mirrored, the overall picture. There was a lot of stocks that were up, there were a lot of stocks that had a good day, but you had the Tesla disappoint, and supposedly they're not buying iPhones in China anymore. So just a lot of different, circumstances in the market. But you look at today, it's back. The Mag 7, Apple's the only one in the red. But you look across the board, Nvidia, Microsoft, Amazon, Google, Meta, Tesla, the song remains the same here.
Well, I was going to ask you about the song and whether it changes or not in 2025, Joel, because obviously last year was a mega cap tech year. It was a year of AI. Really, the AI theme dominated for a lot of it. The Mag 7 became the Super 8 at one point. To your point, they still are doing quite well. Do you think there's any sectors that lagged in the last year or so that maybe get some of that money rotation? Well, how would you contrast different sectors that are maybe vying for attention?
Several points here to make. And, I think that the jury is going to be out for a little bit. And the reason I think that is because really we're unclear of the rates, right? We're not going to get as many rate cuts as expected. So that, that doesn't always, that's a lot of the euphoria in the market was based on, all these cuts next year. So you got to see what the pay. I say if inflation stays low, then you still got to stick with your Mag 7 no matter what. But I think the other thing, and I'll just go to one specific sector here, and that's the healthcare sector. And it's just had an absolutely horrible. I mean, it's actually up on the year when I look at the XLV now, but the way it finished the end of the year, very bad. And I think that you can attribute that to what's going on with the administration. I think there's a lot of wild cards here. They bring in, Kennedy Jr. here, his attitude towards healthcare. I think that there's a lot of unknowns. So if the bite's not as bad as the bark, then I think these stocks can recover. But I think until you get some clarity from the administration as far as, what direction they're going with their stances toward healthcare, you got to be real careful. And then the other thing that, is concerning and that you got to look for a turnaround is look at your select metals, your XLB. I mean, yep, still positive on the year. Absolutely horrible December. Not off to a great start so far this year. And then you couple that, with the housing sector, the XHB. I mean, boy, you need these things to get a green candle. They both had horrible Decembers. They exited. A lot had to do with the interest rates and the uncertainty over the new administration. So, yeah, there could be rotation into these things, but I think that maybe that rotation maybe just might not quite happen as early as people expect. And in like the January barometer, I mean, we tanked the first couple days of 23 or excuse me, of 24, and look where we ended up. So I think until you get some more clarity, out of the administration, I mean, what if they start raising tariffs? I mean, what's that going to do? Is that going to bring inflation roaring back? So a lot of uncertainties here for these stocks to turn around. And I just think, I think the playbook for this year is going to be a little trickier than it's been in the past. I just don't see. Can we go up another 20% here? Sure, 3 years in a row. I don't know if that's ever happened, but I think it's going to be a stock picker's market, and I expect to see more chop. And I'll just throw out, I give levels and stuff. I like to see this 6,000 level. Man, I use the futures just because that's what I look at the most. And, we flirted, we got to 50, we got to 6,200 and everything was rosy. And then not quite this week, but last week, we were in the 5,800 handle here. I could see a year where they just grind it to death. Oh, we're going to the moon. We go up and make a new high. Then we come back down under 6,000, maybe go to 5,700, get back over. So watching that 6,000, if the market can get over that 6,000 barrier, nice round number, make a sustained bid, then hey, we're making a shot back for all-time highs. But I think there's a big tug of war going on in the market, and I think that's due to uncertainty. And you know what? You can make all the cases for a bull or bear market if you want, but you know what you have just around the corner, starting in next week?
Yeah.
For earnings season.
Oh, earnings again.
Yeah. So are these companies going to come out and beat? Some of these companies going to come out and say, that the big exporters are like, hey, yeah, we beat, but the strong dollar's killing us, man, and they're going to give you lower guidance. Tech will do what tech does, but let's see what what the earnings expectations are, and you have to keep in mind that the S&P is trading at such a historical high valuation that their earnings are going to have to come in and beat and also be able to maintain the lofty expectations.
The constant battle there, right? As these markets keep moving higher and earnings, well, they keep getting adjusted into. We constantly see earnings being beat. But Joel, even in this market environment where it could be choppier, where we do have higher valuations, do you see fear in the market right now in any broad sense from investors?
No. I
So
don't.
is that a concerning factor for you, or does that just mean that, yes, we might get choppy, but it still might be an okay environment?
I think just what you have here is just the money's just going to move around, and, right now, value is being beaten down. We'll see, how long that carries through. Maybe if, the Mag 7, earnings expectations don't come in as prescribed, maybe you'll see a little rotation out of that, but then they go into the value, which is a big part of the index. So it seems like there's two things you got to keep in mind. The Fed's going to have the markets back, right? If it looks like we're really starting to slip into recession. And, the president-elect, I mean, he's not going to want to have, I mean, he could talk tough about tariffs and everything, but, let's see what he follows through on. Let's see what he does. And, with the president-elect that's so worried about his, his personal, how he looks in society, I mean, he's going to have the markets back too. So you're going to have an administration and a Fed that's going to have the markets back. So I don't see fear, and I don't quite see euphoria.
Well, and Joel, to that point, I don't see anything that's that interesting on the downside or the upside as far as the economy. The data that's been coming in for GDP is showing about 2.5% growth, which is good, but not great, but it's not bad either. When you look at the jobs numbers, they've been okay. When you look at manufacturing, it's been improving. When you look at the real estate market, it's not fallen out of bed. It's not rocking to new highs, but everything seems to be hanging in there as a theme. Do you think when the Q4 numbers come in for retail, that could be a particular interesting point because Q4 is the most important quarter for retail. When we get those numbers, will that give us some insights into the consumer and the health of the average American?
Yeah, I mean it all like retail is a very broad term, right? Because the retail will go, will chase the hot money, and chase your hot stocks. I think investors are at the point where the buy the dip mentality has been so ingrained in them and has worked so well for so many years that unless you just get, rampant inflation or it just looks like the economy is falling off a cliff, you have to be concerned with the price action in in the materials and in the housing market. But, once again, I mean, buy the dip, you've seen that work for so long. I don't think that the retail investor, I mean, yeah, maybe they can be happy with 4 or 5%, but no, it just doesn't, the market's been too kind. I would like to see the volatility come down here a little bit, maybe have a little bit of a quiet period, get the, average daily ranges come in a little bit, calm down, but that just kind of seems that's not how the computers are programmed. So you got to take what the market gives you and live with the results.
Computers are very much programmed around the data and around what the Fed does too. Something you and I chatted about a few weeks ago, right after that Fed meeting, was the Fed's projections, which are now for rate cuts next this year being a lot lower than what people expected. That doesn't seem to be weighing on people now. Does that have a longer term impact throughout this year if the Fed is now telling us we're probably only going to get two 25 basis point cuts?
But I think I've argued on this on these interviews with you or discussed on these interviews that, I didn't, when rates were going up, I didn't think that they were going to go to, 6, 7%. And then I really, frankly, did not really think they should have started cutting when they did. But I think it's just all about, I think the most thing about rates is stability. And I think that people that are looking for these oversized moves in interest rates are kind of putting the cart before the horse. I mean, we've had some wild swings. I think the Fed was prepared to cut or to raise rates going into 2020, and you had, the pandemic. So I think everything's just back to normalcy. And I think that having rates, stable rates, if you choose to be in some kind of fixed income or interest bearing, and, if you're older and getting close to retirement. So I think that the big spook, and I'm probably going back 2 weeks ago from Wednesday, with the Fed, and Powell, only two cuts. And then, a couple days later, Goolsby comes out and says, everything's fine, economy's humming and inflation's in check. So I think you have to keep an eye on how earnings season goes, not so much how the earnings are, but what's the guidance, and then see what the inflation, see if inflation's creeping back. You did get a little bit of an indication that with the latest numbers, and then the big wild card is what kind of policies is Trump going to pursue. And I personally don't think that the tariff route that he's talking about is going to be pursued as hard as he says it is. So I think you got to keep an eye on those three things.
Well, Joel, is it possible that the U.S. markets, because we're mostly talking U.S. markets here, are going to stay buoyed not just from domestic investors, but also from overseas investors? Because when you look around at the other options, do you want to invest in Japan? Do you want to invest in China that's deflating? Do you want to invest in Europe that's kind of been a basket case? Or do you want to take that money if you're a foreign investor and stash it in the U.S., which is still seen almost as a safe haven? Look at the dollar. It's up at 108.70, 108.80 right now. A lot of that's because people have to convert to dollars to buy U.S. assets. Is the U.S. basically the safest equities to be in on a global basis?
Yeah, I think so. I think though, and if that's where a lot of the major corporations are. The U.S. policy dictates, and the strong dollar. You're in stocks. You in U.S. stocks. You're getting appreciation in those, and then you're also getting. It's kind of like an extra dividend. It's an extra kicker. So until Europe can turn it around, I mean, China's going to have its spurts and stuff, but they can say all they want to what they're going to do, but the price action was just faded hard off their last stuff. So also, people are just they don't believe what they that they hear coming out of China. The stimulus, whether they follow through on all of it, no matter how big they say it's going to be, it takes a while. It takes a long time for those kind of things to filter through the businesses and filter down to the consumer and have a stronger economy.
Where does this all leave commodities then? If the U.S. remains strong, but the rest of the world continues to struggle, what do you think for energy, for base metals, and then even tying in precious metals? Do you see positives for any of those commodity or resource sectors?
No, I mean not until the world starts cranking, right? I mean, just one economy, going. I don't think so. I don't think so. And I think, and we haven't even got into this, and this is probably, a stretch is like, where's AI fit into this and entire picture? Is it going to make, agriculture more, more efficient and you can, produce more out of less land? What kind of a long-term effect is it going to have on employment? Is it going to make businesses, more efficient? Are they going to have less workers? I mean, I'd say out of, over my years of investing, I've never seen so many unknowns, heading to a year. But you can say what you want. The market doesn't like uncertainty, but holding up pretty well today under uncertain circumstances.
Well, Joel, what if we leave the real world and go into the virtual world? What about cryptocurrencies? There's a market that really isn't based on, a national trade situation. It's not based on GDP. It's really based on investor speculation. Do you see it being as hot of a sector in 2025 as it has been in 2024?
Nah, I haven't been too good at Bitcoin, so I'd look at it from a technical perspective. It's found support in the $92,000, $93,000 area, trying to build a base over 100. And what I mean, in this correlation, I haven't fully thought it out and everything, but you know, strong dollar, strong Bitcoin, right? So until if you for people that invest in Bitcoin right now, there's no tangible use for it, right? I mean, unless HODL, but you have to still measure it in US dollars. So I don't until you start to see weakness in the US dollar, I don't think you're going to see any weakness in Bitcoin.
Fair enough, Joel. Thanks for going around the horn with us. Look, a year of uncertainty, what that means for markets. Again, a big question mark, because if we're seeing uncertainty now and we do get some certainty, then maybe the markets do have another leg higher, or maybe some of these question marks turn much more into negatives. Tough to tell. Always fun to talk about, especially at the beginning of the year. Again, Joel Elconin, co-host of the Pre-Market Prep Show. Click that link in the show notes to follow along with Joel's daily commentary. Joel, great chatting with you. Happy New Year. Nice to have you back on.
Okay, thanks, guys.